The ideal retirement portfolio. Let's read this article. We're going to jump around a little bit, but again, one of y'all sent this to me, so let's read this. This video brought to you by the Heritage Wealth Planning merch. Look at that. Look at that. Look at that. Show the world that you ran 5.56 and 7.62. 5.56 millimeters, 5.56 mm, isn't that right? Show the world that you ran 5.56. That one I can't remember anymore. 5.56 and 7.62. Heritage Wealth Planning merch. Description in the show notes. Lots of different colors too. All right, so let's dive into this. It's called the retirement SPT, the retirement spit. All right, that's weird. I guess retirement spot. All right, so let's go into this, and I don't know who the author is. All right, so we're going to skip through this because he talks a lot about other stuff. Center of gravity for retirees. I came across this article by Rick Ferry, and you can actually read or listen to Rick. He's got a podcast, if I can find it. I'm probably not going to find it on the fly. I think it's the Bogleheads podcast, if memory serves, but he's on the Bogleheads podcast. And Rick argues that a 30-70 allocation is optimal, and that'd be similar to a Wellesley fund. But Peter Bernstein argues that for long-term investors, a 60-40, basically the Wellington. The most important element during the distribution phase of a retirement portfolio is the sustainability of income, not the growth of the portfolio, like long-term investors stress upon. I completely agree with that. A bad sequence of return risk or high inflation can substantially decrease the life of a portfolio. Rick points out that a 60-40 split would fall 27% during a 16-month period from... would fall. Rick pointed out that a 60-40 split fell 27% during a 16-month period from November 2007 to February 2009. Well, Wellington actually fell 37% during that time, October to March. In other words, a 100,000 portfolio would have fallen to 73,000 if you include withdrawals of 4%. Your portfolio is now at 68,000. All right. According to Jim Otter's retirement income planning course, the gain required to break even after a 30% loss is 42.9%. Historically, there's only a 63% chance to recover a loss of this magnitude after 3 years, which is the typical length of a cyclical trend. And that's I tell you, after 3 years, that's exactly why we want 3 to 5 years of cash. 2 years isn't enough. 2 years just is not enough. How do we know? Just look at 0, 1, and 2, 2000, 2001, and 2002. 9, 12, 22% consecutively. And going into to the beginning of March of 2003 is when it stopped. I love coffee in the afternoon. I like coffee. So that's why I need 3 years cash. All right, so Peter contends that the center of gravity shifts from 60 to 40 to 30 to 70, where the focus changes from growth to preservation of principal and sustainability of income. A 30-70 portfolio has less volatility with the least risk. On a 5-year rolling risk-adjusted period, 1929 and 1932, the 30-70 portfolio lost money only once since 1929, while the 60-40, I'm not sure why I say 1929 and 1932. That doesn't make sense unless he's saying, I don't know what he's saying. While the 60-40 portfolio lost money 5 times. Retirees will like the lower volatility in down markets. Yep. According to Wade Fowle, the most perilous times of sequence of returns are the first 10 years of retirement. I decided to test the portfolio I needed with a risk-free rate of return of 2% and in a lower yield bonding environment. Using Otter's retirement calculator, I entered a portfolio of $3.4 million, the value needed for a portfolio with a risk-free yield of 2%. I began an initial $70,000 withdrawal. I'm assuming 70 goes to 3.4. I'm assuming that's a 4%. 70 divided by 3. So 3, 4. Oh, yeah, so okay. He's not touching his principal. He's just taking the income out. That's it. I began with a $70,000 withdrawal that I needed for expenses. Using a conservative 1.5% yield for bond/cash, the Otter's retirement calculator said the worst case scenario, I'd run out of money at the age of 90, and an unlikely scenario, I'd run out of money at the age of 94, with 30% stocks and 70% bonds. All right. Factors such as inflation and a slowing economy will affect yields on bonds differently, and I realize this might not be a completely accurate picture. All right, but I wanted to see what the effect of a permanently low yield on bonds might be. All right, so beating inflation. As the human's capital drops to zero, keeping volatility at bay and preserving the portfolio principle becomes the retiree's primary focus. In the long term, stocks have kept. We already know that. So the ideal split. So the research paper offered by Kitsis and Fau is noted that a portfolio that begins and ends with a 60-40 stock bond portfolio with a 4% withdrawal rate ended with a 93.2% probability of success. On the other hand, the portfolio that began with a 30-70 split and ends with a 70-30 split actually gave a higher probability of success, from 93.2 to 95.1. It also had lower volatility and lower average equity exposure during retirement. I increased from 93.2 to 95.1. Yes. I then looked at the same 2% yield risk-free, using, I think, for a 30-year treasury, I presume, using a rising equity glide path. I looked at the analyst that I got from Odar's Optimizer and got a worst-case scenario of $2.8 million. All right, takeaway. The risk-free rate has dropped significantly. As yields drop, the retiree is forced to take on more risk to preserve his income stream and keep pace with inflation. The center of gravity for retirees is 30% stocks, not 60% bonds. I guess 10% cash, I'm not sure. The first 10 years of retirement are the most perilous for retirees in sequence of return. A rising equity glide path may be the answer to maintaining a portfolio with today's low bond economic environment for the retiree. History has shown that a retiree with a 30-70 portfolio rising to a 70-30 portfolio has less volatility and restless. Conclusion. How much? All right, so basically, quantitative easing has pushed us to uncharted territory of low bond yields and high stock valuation. No one knows how this economic environment will end, but using history as our guide and stress testing the results is the best reference we have. All right, so here's this guy right here. I'm not sure who that is. I guess it's TRS, the retirement spot. Amazing facts. All right. Look, man, all this stuff bores me to death. 30-70, 70-30. So if you have 30-70 and then you start going into a more concentrated portfolio of stocks, you'll increase your retirement probability from 93 to 95 with a little bit lower risk. Okay. But I hate to say this. I keep saying this all the time. Wellington was down 22% in 2008. S&P 500 was down 37%. I guarantee you the folks who were down 22% felt just as nervous as the folks who were down 37%. Guaranteed. And then you go into 2009, when the first 3 months of 2009, Wellington, again, from October 2007 to March of 2009, fell 37%. The S&P from that same time fell about 54%. You lost more than a third of your capital in Wellington. Now, Wellington is 60-30. I get that. Wellesley Fund fell about 10% in 2008, and I think it was 17% when it was all said and done. That still fell 17%. All right, no one is sitting there thinking, "Oh man, I dodged a bullet." No one's saying that. They're saying at the end of the day, "Man, I wish I had more in cash and bonds and CDs." I'm just telling you right now. So the way to avoid that is literally just make sure you got enough money in cash to avoid the 3 years of potential for declining assets like we saw in 2000, 2001, and 2002, 1929, 1930, 1931, 1932, 1973, and 1974 as well. You got to have enough in cash or Ginnie Mae in which to offset the sequence of return risk. So the ideal portfolio isn't any of this. The ideal portfolio is essentially saying, look, I got 3 years, 4 years, 5 years of expenses covered by the safe money. Everything else, I'm just going to put in the market, however it be. Wellington, Wellesley, full total stock index, I don't care. But everything else is my not touch money if the markets go down. If the markets go up and I have 100,000 as not touch money and I have now 120, well, I certainly should take the gains off the table for sure. But if the markets go down for 3 consecutive years, I got to do whatever I can to avoid tapping into this bucket. That's the ideal portfolio. Hope this makes sense. Love to hear your comments. Don't forget merch, and we'll put a link in the show notes to this guy's article. Thanks now.